Good morning, dear students. Today we are going to discuss about venture capital. This is the fourth module of financial institution and services, and this is a very important topic in the financial institution and services. You might have heard about venture capital, or it is often termed as VC or venture capital, and you might have heard about venture capitalists. You might have heard about angel investors. These are the terms which we can often see in the newspaper and business newses. So after completion of this module, you will be able to understand what is venture capital and what are the important things are there in the venture capital and how venture capital finance can be raised and how venture capital companies are running their business, etc. Okay, we'll start. So this is the explanation about venture capital, some of the brief idea you will be getting after this slide. Anyway, I'll be giving what is venture capital in a very brief way. Venture capital business proposals are those business proposals which involve huge risk and huge return. So these 2 points you must remember, that is those business proposals which involve huge risk or huge return or high risk or high return. That kind of business proposals are known as venture capital business proposals. Okay, we'll see what is written in the PPT. So it is a private or institutional investment made into easy early stage or startup companies, especially new ventures. As defined, a venture involved risk having uncertain outcome in the expectation of a sizable gain. Venture capital is a money invested in business that are small or exist only as a initiative but have huge potential to grow. The people who invest this money are called venture capitalists, that is VCs. The venture capital investment is made when a venture capitalist buys shares or such company and become a financial partner of the business. The venture capital investment is also referred as the risk capital. So sometimes venture capital can be termed as risk capital or a patient risk capital, as it includes the risk of losing the money if the venture doesn't succeed and take medium to long term period for investment uh, to get the benefit. And the venture capital typically comes from the institutional investors and high net worth individuals and is pooled together for a dedicated investment firms. So sometimes the venture capital finance can be raised from institutional investors. So in institutional investors, we have already seen what is institutional investors. But for your better understanding, I'll be saying what is institutional investors. So institutional investors are those investors. They have huge amount of money to invest, and especially they are institutions and they are ready to invest their amount of money into the business which are not well known or the business which is not proven yet. That kind of investors are known as institutional investors. They are also ready to invest their amount of money into this venture capital. That venture capital means those business proposals which involve high risk and high return. And sometimes high net worth individuals. It is often termed as HNI. HNI means high net worth individuals. These are the people who are having huge amount of savings and huge amount of money. They are also ready to invest their amount of money into such venture capital businesses because they are not getting enough return from banks or any other financial institution. That is why they are ready to invest their amount of money into such new ventures, which is not proven yet. Then history of venture capital. So some of the bulletin point you can see, five bulletin points you can see. This is the brief history of venture capital. It has started during the Second World War. After Second World War only this particular subject, that is venture capital subject, has grown. So earlier it was a subset of private equity, and later only it has grown like this. And the second point, Harvard Business School professor Georges Joliet, he is generally considered as the father of venture capital. So he is the person who coined the term venture capital, and that is why he is considered as the father of venture capital. And he had initiated some of the venture capital in those days. And he started the American Research and Development Corporation, that is ARDC, in 1946 and raised a 3.5 million US dollar fund to invest in companies that commercialize technologies developed during World War II. So we know that after World War II or during the Second World War, many development happened, many inventions made, many uh, what all products which we are consuming today, some of the products are from the invention during the Second World War. So these all things happened during the World War, and after the World War, there is a huge demand for new ventures, and many people are ready to invest their amount of money into such businesses. So that really accelerated the concept of venture capital. And next point, ARDC's first investment was in a company that had ambitions to use X-ray technologies for cancer treatment. So this was the first venture capital idea where ARDC invested their amount of money. That is the use of X-ray technology for cancer treatment. And the two lakh dollar or 2 million US dollar that Detroit invested turned into 1.8 million when the company went public in 1955. So this number shows the potential of venture capital, because they have invested only 2 million US dollar, and that turned into 1.8 million US dollar. So this shows the growth of venture capital business. Then definition of venture capital. So here we will be considering the definition from the perspective of Securities and Exchange Board of India. We know that Securities and Exchange Board of India is a premier body which governs the venture capital business in India. Not only the venture capital business, they are considered as the watchdog of Indian capital market. So as per the definition of SEBI, that is Securities and Exchange Board of India, venture capital fund, um, a fund established in the form of a company or a trust which raises money through loans, donations, issue of securities or units as the case may be, and market or purposes to make investment in accordance with the regulation. So this is the definition. So sometimes this definition you can expect for your examination. So we don't have any other choice. So please try to understand the meaning, and please try to uh, remember this definition. You can expect this question for your examination. Then rules by Securities and Exchange Board of India. The venture capitals are regulated by SEBI, that is Securities and Exchange Board of India, under the Venture Capital Fund Regulations 1996. The following are some of the provisions. So the first provision, a venture capital fund may be set up by a company or a trust after a certificate of registration is granted by SEBI on application made to it. On receipt of the certificate of registration, it shall be binding on the venture capital fund to abide by the provisions of the Securities and Exchange Board of India Act 1992. So once the venture capital business is started in the sense if they have raised fund through venture capital business, they have to follow the rules and regulations of Securities and Exchange Board of India Act in 1992. A venture capital finance or fund may raise money from any investor, that is Indian, non-resident Indian, foreign, provided the money accepted from any investor is not less than rupees 5 lakh. The venture capital shall not issue any document or advertisement inviting offers from public for subscription of its securities or units. So this is the second provision mentioned in the Securities and Exchange Board of India Act 1992. And the third provision, the SEBI regulations permit investors by venture capital fund in equity or equity related instruments of unlisted companies and also in the financially weak and sick industries whose shares are listed or unlisted. So this is the third provision mentioned in the Securities and Exchange Board of India Act 1992. And the next point, at least 80% of the funds should be invested in venture capital companies and no other limits are prescribed. So if any company they have started their business as venture capital financing company, they should invest at least 80% of their fund for such business. Such business in the sense it should be venture capital businesses. That is prescribed by Securities and Exchange Board of India Act 1992. Then SEBI regulations do not provide for any sectoral restrictions for investment except investment in companies engaged in financial services. So another important provision mentioned in the SEBI Act, that is there are no any restriction with regard to the sectorial restrictions. Sectorial restriction in the sense there is no any restriction with regard to the investment in certain sectors We know that there are different sectors like telecom sector, petroleum sector, IT sector, banking sector, etc. So there are no any restrictions from the part of SEBI, but there are some restriction with regard to financial services. So that is also mentioned in the SEBI's Regulations Act.